Up until now, our discussion of cost, volume, profit analysis has been based on the assumption that the firm only makes one product, so we know the contribution margin for that product. However, that's not very realistic. Most firms make lots of different products. So our last topic in this chapter is how to handle cost, volume, profit analysis in a multi-product firm. Obviously, most firms make and sell lots of different products. The trick for this method is that the firm needs to know the approximate proportion of each product that it sells. Let's see how this works. Let's take a look at our firm, Acme Widgets, and assume that now it makes two products, A and B. Product A is the one that we've been studying throughout the chapter. Product B is brand new. The firm estimates that it will sell 9 units of product A for each unit of product B that it sells, and we want to figure out the break-even point for this product mix. Here's some data for each of the products that Acme makes. Product A should look very familiar. It sells for 60 cents per unit. It has 36 cents of variable costs per unit, and that gives it 24 cents of contribution margin per unit. Product B is the new one. It sells for $1, has 56 cents of variable cost per unit, and that gives it 44 cents of contribution margin. Before the firm started making product B, it had fixed costs of $1,500, but now it needs some new equipment in order to make product B, and that's increased its fixed cost. To do cost volume product analysis for a multi-product firm, we first need to find what's called the weighted average contribution margin for the mix. We know that 9/10 of the units that Acme sells are product A and 1/10 is product B. That means that Acme estimates it will sell 9 units of A for each 1 unit of B. To find the weighted average contribution margin, we have to combine the contribution margins of the two products in proportion to their contribution to the total mix. So we multiply the 9 units that product A contributes times its contribution margin per unit of 24 cents. And we multiply the 1 unit that product B contributes times its contribution margin per unit of 44 cents. Add those together, and then divide by the total number of units in the mix. 9 units of A plus 1 unit of B gives us 10 units. The result is the weighted average contribution margin for the mix. We can check this number for reasonableness. We know that averages are always bigger than the smallest number and smaller than the biggest number. When we compare the weighted average to the contribution margin from only A, we see that it is bigger, which makes sense. When we compare it to the contribution margin for B, we see that it's smaller. And because A contributes so many more units to the mix than B does, the weighted average is much closer to the contribution margin of A than it is to B. So this number is reasonable. And that's the number that we're going to use to find break even. In order to find break even for the mix, we're going to go back to our basic formula. Break even for the mix will be the total fixed cost plus 0 profit at break even divided by the weighted average contribution margin. Now, all we have to do is fill in the total fixed cost and the weighted average contribution margin that we just computed. When we crank this out, we find that the firm needs to sell 7,000 units in order to break even. But that doesn't tell us how many of each kind of unit. So we need to do a little more math. In order to compute the number of units of each kind of product in the mix, we take the proportion of product A, 9 out of every 10 units, and multiply it by the 7,000 total units. That tells us we need to make 6,300 units of A. For product B, it represents 1/10 of all of the units sold. Multiply 1/10 times 7,000 units, and that tells us we need to make and sell 700 units of product B. We can check these numbers to make sure we didn't make a mistake by adding them up. And in fact, it equals 7,000 units. We can also check our work in another way by figuring out how much operating income this mix would make. If we sell 6,300 units of product A, we can figure out at 60 cents per unit how much sales revenue that would generate. We can do the same thing for product B by multiplying the 700 units we expect to sell times its sales revenue per unit. We can do the same thing for variable costs. Multiply the 6,300 units of A times its variable cost, and multiply the 700 units of product B by its variable cost. Now we can determine the total contribution margin for product A by taking its sales revenue and subtracting out its total variable costs. We can do the same thing for product B by taking its sales revenue and subtracting out its variable cost. Then we can add the total contribution margin from product A to the total contribution margin for product B and that will give us the total contribution margin for the mix. Subtract out the total fixed costs, and that gives us operating income of 0. Therefore, if the firm is right and it sells 9/10 product A and 1/10 product B, it needs to sell 6,300 units of A and 700 units of B in order to break even. Of course, the firm could expand this analysis by determining how many units it needs to sell in order to reach some target profit. This is a very flexible method. I've shown you how to do a cost volume profit analysis for a firm that makes 2 products, but most firms make far more than that. Of course, if they were going to expand their analysis, they'd probably want to use an Excel spreadsheet to help them with the math. This is the end of our work on cost volume profit analysis.